All right, we are about 2.5 minutes to the closing bell, and as we cruise to the end of the trading session, we're going to do that with Simeon Hyman, ProShares Global Investment Strategist, as well as Hal Reynolds, LA Capital Management CIO. But before we talk to both of those folk, let's go to Jared Blickery, who's watching the last trades of the session. Jared?
That's right. And let's get straight to the charts and look at the week that is the Nasdaq. And as it appears, the Nasdaq will end the week about 2% in the hole right now. Also taking a look at the S&P 500, should be in the green, just a smidge there. And then the Dow up 1.9%. Finally, the Russell 2000 also in the red, likely for the week. But let's take a look at some of the other things going on in the market today, namely the stocks that are on everybody's radar. They flipped from yesterday. And in fact, we've seen this many, many times over the last few weeks where trends only last 1, 2, 3 days at the most. So we have Alphabet here up 3%, Facebook up over 2%, notably Tesla really dragging down risk markets by itself, especially as a sentiment indicator. Lots to do about the ARK Invest ETF gaining attention, but that is down 11.6% for the week. Now, looking at the sector action, and let's do this on a 5-day basis, and here are our sectors. We had energy really slinging higher here. That's up almost 10%, followed by financials and industrials. Those are up 4% and 3% respectively. And so it's really been all about the value and cyclical play here. And if we can go back to a chart here for a second, I'm going to show you what happened in the bond market, because this has been key. This has been the focus of the week, not only because Chair Powell did not address some of the dislocations that we're seeing in the bond market or suggest any solutions that might be on the horizon at the next FOMC meeting in a couple of weeks. Not only that, we see the 10-year solidly above the dividend yield in the S&P 500. It is now 1.55%. So we've been saying maybe good news is bad news. We had some nice surprises on the payroll report this morning, led to some initial consternation because of this move in the bond market, but ending with a bang here. And just back to the S&P 500, I want to check out the technical structure. We were sitting on 1% losses earlier, and now we are set for gains of nearly 2%. That doesn't happen very often. I went back through history and checked, and, kind of palms up here. It didn't really produce any results. Anyway, here's the closing bell on Wall Street, guys.
And that does it for the trading week. As we wrap up what has been a very volatile week, Jared was just bringing us some of those stats here as we try to wrap our brains about what investors are thinking. For the day, though, it looks like investors were very encouraged about that stronger than expected jobs report that we got out before the bell. At least this afternoon, we saw some buying into the close. The Dow closing up 573 points, S&P up just around 2%, the Nasdaq up 1.5% for the week. No, though, it was a bit of a different picture. The Nasdaq ending the week in the red, and of course, that's reflecting that risk-off approach that investors were taking as we saw the pop in yield. Sector action, which I was just saying, energy by far the winner this week. Energy up at 10%. Real estate, consumer discretionary, and technology were the underperformers for the week. We want to bring back in Simeon Hyman and also Hal Reynolds to help us better understand what's going on. And Simeon, just first to you, this higher yields obviously spooking some investors. Is it worrying you?
Not as long as it comes along with good economic data. This is a replay of March 1st. On March 1st, we had that blowout 60.8 reading on ISM manufacturing, saw almost a day exactly like this. Today, we had very strong payroll. So, when the news comes from good economic news, and of course, you're coming from very low rates anyway, it's generally okay for the broad equity markets.
I want to go to you, Hal, because I know that you're advising your clients to really look at small cap stocks. And I'm just looking, I've got my app open here for Yahoo Finance, and the Russell 2000 1 year, if I'm looking at this correctly, the gain has been dramatic. It's up over 50%, whereas just year to date, it's up about 10%. So it seems to me like I would listen to what you're advising your clients. Can we continue those kinds of gains?
Well, there's no doubt we've seen very strong rotation into small caps, but there's one thing I think we need to really watch out for, and that is the riskiest part of the small cap market, those stocks, and it's about a quarter of the stocks that don't have any earnings. They've actually outperformed stocks with earnings by about 40% over the trailing year. Now, if you look at the last 20 trading days, though, they've underperformed by about 7%. So finally, the market is coming back and with earnings. and quite frankly, those companies whose earnings outlook is improving going into 2021. And so, yes, we like small stocks. We think they'll outperform large stocks, having really underperformed for the last 5 years. But we really like the higher quality stocks, those that have better cash flows, particularly in 2021.
Simeon, we also have this debate going on right now in the Senate, the $1.9 trillion stimulus package. Do you think that's going to have any material impact on the markets next week if we do get it passed?
Well, I think a lot of it's baked in, but the story here is about real interest rates rising, more so, I think, than inflation expectations. We've seen tips actually perform quite badly because there's still slack in the economy. So, as we get that stimulus, in all likelihood, something pretty darn big, I think it's for the most part really to the good side of the equity markets because it's good for economic growth. But remember, those real interest rates are growing. And I love that comment on quality stocks because that I think is true not just in small caps, but in large caps as well. This value trade, the junk trade, it has some momentum. But take a look at the difference between, say, the S&P 500 dividend aristocrats, those companies that have grown their dividends for 25 straight years. They grew their dividends 14% last year. And that's a real asset as we go into the expansion, which is going to have some hiccups. And if you look at the value side, we just talked about small caps on the lower quality side. Even in large caps, the dividend payout ratio for the S&P 500 value index went to 111% last year. So we think the rotation trade here is quality across the cap structure. And our favorite way to get there is focusing on companies that continuously grow their dividends.
Hal, I want to continue this discussion about dividends because I think there are a lot of conservative investors who look at trying to make long-term investments that are somewhat risk-free, although every investment has risk. And in the last year, some of those investors got burned because companies suspended dividends. I'm talking companies like Royal Dutch Shell that hadn't cut its dividend in 40 years. So is it safer today to be looking at a dividend play than, say, just 6 months ago?
Absolutely. 2020 was an anomaly. Typically in downturns, when the central banks are cutting rates, dividends are where you want to be. If you can't earn anything in a money market fund, oftentimes investors will go to the equity market and go to the highest quality companies with higher payout ratios. That did not work last year, but that was an anomaly. So absolutely, I agree. It's a good time, again, to look at dividends. I guess the one caveat is I think there is a risk of some transitory inflation in the next year. With all the stimulus that's in place, I think we could well see inflation go well above 2. The central banks, particularly here at home, have said that they're going to be a little bit more liberal than they've been perhaps in the past. And I think we could see some inflation spike short term. Longer term, I think most of us aren't terribly concerned because of the demographic situation. So anyway, that's one thing that could put pressure on dividend stocks. But if inflation were to really pick up, but I think on the whole, particularly because of the underperformance, I think because of the higher quality, the higher probability of those cash flows, I think investors are going to be very interested in that. And I agree. I think the recovery, it's not all going to be good news in the next 12 to 24 months. And I think investors are going to appreciate the stability of those companies that have lower earnings variability and are able to continue with sustainable dividends.
Simeon, real quick, do you see any opportunity outside the U.S., any opportunity overseas? Because we've talked to a couple of our guests here over the last couple of weeks, and they actually saw opportunity in emerging markets.
Yeah, I think if you let's split it up into developed and emerging. Emerging markets, even in 2021, has a heavy element of commodity influence. And so that, of course, is the offset, because sometimes you say that you got to have easy money for emerging markets. I think at least as important is better commodity prices. So I think that can help a lot. And in developed markets, look, you're trading at a 50% discount in Europe. The long-term average is 30. We would suggest the same focus on quality is critically important here because you have challenging backdrops with regards to regulation and market structure in Europe and even in the UK in the wake of Brexit. So again, the quality story being very important. And just to put a finer point on the dividend story, if we are getting a little bit of extra inflation, it's all the more important to focus on the growing dividends as opposed to the higher yielders, because the higher yielders will catch a little bit of a cold if those rates do go up a little bit more quickly than we expect, whether from real rates or from inflation.
Simeon and Hal, hold on right there, because Jared, as we talk about this potential for inflation, the bond vigilantes are trying to get the Fed to take action. What's your final thought on this?
Yeah, well, let's take a look at the charts here. And this is a longer-term view of the S&P 500. You can see we broke below the 50-day moving average, and now we closed above it. This could very well be a fake out. We only suffered about a 4% loss from close to close here. But thinking about the bond market in particular, I don't know that we've seen the all clear from that, because we're seeing problems continue to get worse within the repo market. That funding stress could lead to higher yields next week. And although today real yields, as Simeon was talking about before, it's important to monitor those. Those were down on this economic data, and break-even inflation expectations were up. I think that signals that we're going in the right direction, perhaps, but not taking care of this funding stress in the short-term markets could set us up for more downside last week. But nevertheless, we are also seeing the U.S. dollar index heading higher. And I think this is an additional potential headwind for markets coming into next week. So maybe not the all clear from all the markets just yet, but the S&P 500 actually looking fairly constructive on the close.
Jared, thank you. And thank you, Simeon Hyman, ProShares Global Investment Strategist, as well as thank you, Hal Reynolds, LA Capital. We appreciate you both being here.